Hey, I think you bring up a great point where, and what the individual investors and our clients is looking at, well, why would I ever invest in bonds when you don't receive any yield? There's no income. So they're taking on way more risk than I think they realize until something's going to happen.
Exactly. The strategy of, say, replacing dividend, replacing safe bonds. Today, you can buy a 10-year CD at about 2.3%. That's a lot better than a 10-year Treasury at 1.36. So, but still not great and tough for many people to live on. Certainly, they didn't plan on rates being that low. So then they go and buy things like REITs, which have higher yields, or utility stocks, or junk bonds, preferred stocks, etc., not realizing that those things are highly risky when the risk shows up. So it's like throwing pennies in front of a steamroller. You can keep running out and picking up those pennies, 99 times out of 100, you're safe, and then one time you slip and your shoelace gets caught and you're, steamrolled over and you're gone. And that's exactly what can happen to these investors who are making these mistakes. I've written a piece just the other day because I had a lot of people calling me about preferred stocks, and I pointed out how miserably they did. Well, safe bonds were going up 15, 20% in '08, depending upon maturity. These things were dropping 25% in that same period, so they underperformed by almost 50%. And so people are stretching for a few more percent of yield while taking on that massive risk. What they need to understand are bonds are not for return. They are to dampen the risk of the overall portfolio to an acceptable level. And if you want or need higher returns, take it in equities and shift your equity allocation, say, away from the U.S., where the expected real return is about 4% because the Cape 10 is 26. You can get in the non-U.S. developed markets closer to about a 7% expected real return. So add inflation to that, and you're up to, say, 9 by investing in those countries because the Cape 10 is roughly 16 or so. And in emerging markets, the Cape 10 is about 12 and a half or so, maybe even a bit less. That gives you an expected real return closer to 9% before inflation. So, you're up in 11 or something like that after considering them, as a nominal return. That's way more than the U.S. is. So there are alternatives, and of course you can also tilt to more small and value stocks.